Hello and welcome to Wall Street Training's LBO Leveraged Buyout Overview course. Please note that these materials are copyrighted and may not be disseminated or reproduced for any reason without express written consent from Wall Street Training. Now on page 26, let's go into additional detail on purchase accounting versus recap accounting, left-hand side. As we said with purchase accounting, you will blow out your target accounts, blow out your equity. This is your equity accounts. What that means is you will start off, you will take your existing actual balance and you will minus that balance. Why? Because you're blowing it out. Zero, it's gone. Kaput, zilch, not a zip, gone. Therefore, it's gone. What will you add to that? Very simple. The amount of equity you raised from your sources and uses. This is your private equity sponsor contribution. Okay, that's how much money they're putting into the company. So simply stated, your pro forma balance is your equity amount from your sources and uses. Very straightforward. Retained earnings. Again, you will say, well, blow out your existing balance. So you start with your actual and you blow it out. Then as we have mentioned with our expenses, you will expense your tender costs immediately. Why do you expense it immediately? Only if your debt is refinanced, because that debt is no longer outstanding. Therefore, what we're saying here is zero. If you're not refinancing, in other words, fresh start, you have a zero pro forma retained earnings balance. Effectively, you've wiped away your entire balance. Recap accounting, we were not blowing out our target account as we did here. What are we doing? Marginal changes only. We're not buying the whole company. We are actually, but the accounting treatment says what? Start with your actual balance. Pretend you did a massive share repurchase. How massive? Well, 94.9% at least, or at max. So you start with your actual balance and you minus the amount of equity you purchased from your sources and uses, from your uses in particular. That will be that $14+ billion, 14,871 if I'm not mistaken. To that, you're saying, I will buy back $14+ billion of equity, and how much am I putting back in? Let me erase that. This is a positive sign, so what we're saying is we are putting back that $4.26 billion that we're putting back into the company. So again, this is why it's the difference between the equity purchase and equity injection. This is a big negative number. Why is this a big negative number on the recap accounting? Because you're buying back a huge amount of stock and you're putting in a lot less of additional equity. The retained earnings balance is somewhat similar. Again, recall in purchase accounting, you blew away your existing balance. However, in the recap, you do not. You take your current existing actual balance and you just make marginal changes. Again, you make marginal changes. Marginal changes. What are the marginal changes? Transaction costs. Because if you recall, transaction costs here are actually part of goodwill in purchase accounting. So if that's part of goodwill, in the recap accounting, we're not actually creating any goodwill. Because we're not creating goodwill, these transaction costs are expensed immediately, as are tender costs, as we talked about under purchase accounting as well. And therefore, your pro forma balance is the existing balance that you started with, less any additional cost. These are marginal changes only. And that will be important because why? Again, no goodwill created under recap accounting. No goodwill created. And you will see when we build our complex leveraged buyout model and when we get to the pro forma balance sheet adjustments, how exactly all of this will still continue to balance and equalize itself.